Hey guys, everything in my lesson or review today is taken from Century 21 Accounting Textbook by Cengage. Lesson 10.1 is about a new subsidiary ledger. This one is for accounts receivable. The one we learned in the last chapter was accounts payable. Now we're learning a new one called accounts receivable. Just like we have the broken down accounts for accounts payable, we do the same thing for the accounts receivable. So for a company who has a ton of sales, there's probably a person for accounts payable, and then there is a person that just does accounts receivable. So Wells Apartments, Scanners College, Palmer Destiny, all of these are broken out into subsidiary ledgers written on the books. Then you can find the whole number in the accounts receivable general ledger. So we have the accounts receivable ledger, accounts payable ledger, and the general ledger. So I wrote this down. We already know about the accounts payable ledger. We are going to learn about the accounts receivable. Let's see. Yep, you can see that. So accounts receivable, and then you already know about the general ledger. So these are subsidiary ledgers 1 and 2. The general ledger is not a subsidiary ledger, so let's erase that. We have general ledger. It's just that primary, that basic ledger account where we can record everything. But when we want to break down the accounts payable and when we want to break down the accounts receivable, that way we can tell accounts receivable who owes us. Because when we use an accounts receivable, it's an asset account, and so we are going to receive that money. We no longer have to pay it like accounts payable are. So again, these accounts over here are the subsidiary ledger, or that accounts receivable ledger. Then you have the controlling account, which is the group amount of accounts receivable posted in the general ledger. So this amount in the general ledger should equal the total of all the subsidiary ledgers, one account for each customer. Down here, it talks about the selling of merchandise. Merchandising business gets its revenue from the sale of merchandise. So a business has the selling price. This is the amount of money it receives from the sale. The amount a business adds to the cost of merchandise to establish the selling price is called a markup. So you do the cost of the merchandise. Let's say we're a merchandising business. We bought a box of t-shirts to sell. Let's say we are American Eagle. Bought that box of t-shirts to sell. That's the cost of it. Then we say, hey, we bought this box for XYZ, breaks down to $5 a shirt. We want to make some profit on it, so let's mark it up by $10. Let's sell it for $15. Their markup is the 10, the cost was 5, and now they can sell it at a selling price for the amount of money that they desire. There are 2 types of sales for merchandise. You can buy something on account, or you can pay cash for it. Regardless of the payment, the revenue should be recorded right away when the sale is made, not on the date that you receive cash. So if you make a sale on June 15th, sold merchandise on account to a customer, and then the customer doesn't pay till July 9th, record it as a sale on June 15th. Don't wait until July 9th. That's just a standard practice in accounting. So record it when the sale is made. Last thing discusses this accounts receivable ledger. It's a subsidiary ledger or a controlling account. It's a subsidiary ledger containing all the accounts for charged customers. This is the controlling account. These are the subsidiary ledgers. Controlling account is just that amount in the general ledger. All the accounts broken down is the subsidiary ledger or the accounts receivable ledger. Finally, over here shows the normal balance of an accounts receivable. Normal balance is a debit always, okay? So accounts receivables are assets. The numbering part of this is 3 digits, 3 digits, 3 digit. The first digit represents the division of the chart of the accounts, which we learned about. Any kind of asset is usually indicated with a 1. The second is usually a unique customer number. And the third would be any kind of additional digit that you may need. So 110 is for Belk and Jensen. 120, well, 1 we can see, okay, that's an asset, and maybe all the accounts receivables are between 110 and 160. And then you can fill in the other amounts in between. Let's go on to the next page. Here is the subsidiary ledger form. We'll start at the top. Of course, accounts receivable has that debit balance. So here's the general ledger form of an accounts receivable. Date, post reference, the item we usually leave blank unless we bring forward a balance. Debit and credit, as well as debit and credit, the running balance. Here, we will always have a debit balance for our customer's account. So this is just opening up or starting a new page for this. Let's say the prior page was filled up for this subsidiary ledger for this accounts receivable. So we put the date, we write balance because we're bringing forward a balance. We write the customer name, the customer's number, post reference mark because again, we're just bringing forward something from the previous page, and then we write in the total debt or the total debit balance, which is $3,060.95. This is just how to open up a form. So here is the general ledger form, which we have already seen before. But when we do the subsidiary ledger form for accounts receivable, this is what it looks like. It no longer has the credit balance. That's what accounts payable had because liabilities normal balances are credits, but accounts receivable normal balance are debit. So it'll never be anything different. You determine if you add or subtract by whether you're debiting or crediting. So if it's a debit, you would add it. If it's a credit, you would subtract it. Next section talks about sales tax. If you know, Pennsylvania has a 6% sales tax. Sales tax is a tax on a sale of merchandise or service. Many states require it. Maybe some towns require the sales tax. It's kind of just a way for the government to make some type of money. A variety of customers, including individuals, businesses, and schools and churches sell merchandise, and so it's important to recognize which companies require the sales tax. Usually it's when it's being actually sold for something. So at the grocery store, you have to pay sales tax on those items. But typically, you're exempt from the sales tax if you are reselling the item. So I'll read this to you. A sale on merchandise to a business that expects to resell the merchandise to its customers is normally exempt from a sales tax. So typically that grocery store buying products to resell, they're not going to have to pay the sales tax when they buy it because they're not the final customer. The final consumer of that product normally pays the sales tax. Here at the bottom just talks about like two kind of exemptions. Sales of necessities such as food, medicines, and clothing might not have sales tax, and then sales to nonprofit organizations such as schools, churches, and government. So the school does not pay sales tax on things. Churches have a tax exempt form that they can use, and they don't have to pay sales tax when they buy certain things like maybe food for the cafeteria or even textbooks or things like that. They typically are exempt from it. Here you can see this new account that we're learning. Payable means to be paid. Payable. We have to pay it. Sales tax payable. Payable liability. Okay? Liability is normal. Account balance is a credit, so it's going to increase on this side. So sales tax payable is the account that just accumulates what we owe the government. Okay, so a lot of times you don't just make a sale and then send a check to the government. You yourself have to record the tax in the payable account. So every sale you make, you have to make sure you're recording that you're paying or putting money away in an account called sales tax payable. You owe this. Then the government will send you a form, or your accountant will say, as a business, your accountant will say, hey, it's time to pay the sales tax, and they will take whatever you had been recording in your sales tax payable account, pay it to the government. Then this decreases down to zero. Okay, this is important, sales tax payable, because if you're not making sure you're putting money aside for your sales tax, it's going to show that you've made more income than what you think. For example, when I was doing the Roller Roost books, I had to create an account for my sales tax, and I didn't at first. And so I was just not recording any sales tax on my books, and then when it came time to pay the sales tax, my accountant said, hey, how much is your sales tax payable? And I said, oh my gosh, I've been forgetting to record that. So we had to go backwards and see, how much sales we had times that by whatever the percentage was to find out how much I actually owe the government, because the government can come back and audit my books and actually end up suing me if I'm not paying, or fining me, I should say, if I'm not paying my sales tax. But we put it into that payables account because you don't always just send the check to the government right away. You need to accumulate it, and then they expect a check in lump sum. A lot of it's on the honor system, and they can come back and check your books, or let's say you have a grocery store kind of thing, and they know how much sales another company made versus you and that kind of thing, and see, hey, they need to be paying more sales tax than what this shows. And they can come back and look at all your books and audit you. And if they find a mistake, audit means to look through your stuff. If they find a mistake, you could be in a lot of trouble. So the new journal that we're going to learn about, so we just talked about the subsidiary ledger and for accounts receivable, and now we're going to learn about a new journal. I'm actually going to pause the video and start a new one for the next section of this chapter.